Welcome everyone to another episode of How to Make Money in Stocks with Investors Business Daily. Now, a big part of what IBD does is helping people to learn how to invest and make more money in the market. And one of the great ways, and also a free way to do that, is to get involved with your local IBD Meetup group.
Oh, this is something, as everyone knows, this is near and dear to my heart. I want to encourage everyone to join their local meetup group. IBD currently has, check this out, 414 groups with 123,000 members in 290 cities in 22 countries. And these are free monthly meetings. It's a way to connect with other investors, create watch lists, and talk about the general market. So go join your local meetup group. And if you'd like to start one in your area, contact us at investors.com/investingshow.
It really is an absolutely great way to get involved. Like you said, you're learning while also building your watch list and staying in sync with the market as well. So there's no reason, if there's one in your neighborhood, at least not to go check it out once
Absolutely.
or twice and see who's there. Now, on this week's show, we're going to launch a new series about chart patterns, and we'll do an overview of why it's so important to learn how to read charts, as well as to spot the 3 most common and profitable chart patterns. And we're also going to get into this idea of the difference between a good company and a good stock, and why you need to beware when both of those don't line up.
But first, let's take a look at the market. It's been another interesting week in the market.
Indeed.
Tuesday and Wednesday, the market surprised us, and the market moved higher ahead of the Fed decision. Thursday, the Fed came in, and it was anticipated that they were not going to raise rates, and they didn't raise rates.
That's right.
But the market went down anyway. So why did that happen? Well, the Fed said they were worried about global growth, and the market definitely was rattled by that.
Well, let's see what that looks like on a chart. Now, this is the S&P 500, and as Amy said, rallied on Tuesday and Wednesday, tried to do it again on Thursday, but it ended up reversing lower, and then on Friday, it fell again. It was moving averages.
Now, the NASDAQ is also below the 50 and the 200. It's a little bit stronger than the S&P because there's energy names on the S&P.
And on Friday, energy was among the worst performing sectors, so that explains that as well. So this was the context in terms of the technical action on the indexes before and then following the Fed announcement on Thursday when it decided, as you said, not to raise rates. And the U.S. market was not the only one that has been having trouble this year.
Well, let's take a look here. Global markets around the world have been showing some weakness. So the German market is down 20% year to date. The UK is down 14%. Russia is lower by 32%, and China is off by 40%. Then we have Brazil down 19%. That kind of weakness is exactly what has rattled the market.
That's right. But it's not all doom and gloom. We have many quality growth stocks that are forming bases and could be setting up to make a new run, and maybe it'll be earnings season that triggers that.
It absolutely might be. Now, going through the IBD 50, there are a lot of stocks that are in bases.
Right.
And as Matt just said, what could happen here is the market's been under some pressure, and that's when bases are formed, either during a correction or when the market's under pressure.
Right.
We get around to earnings season, and if some of these stocks have good reports, they may break out of those price consolidations.
Absolutely. And Starbucks is one of those stocks that could be setting up. These are not recommendations. We don't know what's going to happen, but these are worth looking at. Starbucks has had great success with its mobile order and pay technology, and it actually got over 21% of sales from mobile orders in August. Now, Nike is another one that's been basing, and it reports next Thursday. So we'll see how that plays out.
Nike is a good one. Under Armour's shares hit a new high this week after announcing that they expect to generate $7.5 billion in revenue by 2018. And they are hoping to expand their female customers. They've had great success by sponsoring ballerina Misty Copeland, NBA star Stephen Cole, golf giant Jordan Spieth, tennis star Andy Murray, and former supermodel Gisele Bündchen.
And one note on that idea of the goal being $7.5 billion in revenue by 2018, that would mean that Under Armour doubled basically its sales during that time. That's fast growth. And one analyst actually thinks that may be a conservative estimate.
Well, then we had Fitbit. Fitbit soared 21% for the week after receiving an analyst upgrade. And Target recently signed a deal with Fitbit to offer the company's fitness trackers to its 335,000 employees. The deal is intended to help Target promote employee fitness and reduce healthcare costs. Target employees will receive Fitbit's cheapest device, the $60 Zip, for free.
Nice. Now, Facebook is another name that's been basing. And as we said before, these aren't recommendations, but these are some stocks to keep an eye on. Amazon is another one. And we featured Facebook, Amazon, and Starbucks in the IBD stock analysis videos recently, and you can see those on our site.
Now, earnings due next week. As Matt said, we have Nike. We have home builders Lennar and KB Homes, Cal-Maine Foods, Costco, Carnival Corporation, Darden Restaurants, AutoZone, General Mills, and these are listed in the paper every week in Monday's edition in the B section.
And for ongoing coverage throughout the week, be sure to check out the Big Picture column as well as the Stock Market Today video that Amy and Allie do Monday to Friday. And you'll find links for that at investors.com/investingshow. As many of you know, learning to read charts is absolutely critical to your investing success. And as IBD Chairman Bill O'Neill has said many times, it really is the most important skill that you'll ever learn as an investor. So today we're going to launch a new series to talk about how to spot the chart patterns that launch huge price moves in the biggest winning stocks.
And we use charts because they work. So if you want to make big money, it's necessary to master chart reading. And it really can be a lot easier than what people think.
Yeah, there's no reason to get intimidated at all. Now, the key thing to understand about chart patterns is that they are launching pads. Of course, you can buy a stock anytime
Anywhere.
you feel like jumping into the stock.
You can.
But the question is there a more optimum time to buy? And the answer is yes. There is a time when you have less risk and a higher probability of reaping a nice reward. And that is when a stock breaks out in big volume from a chart pattern, which is also known as a base.
And what's exciting to see is the move, like here we have Baidu, that was launching out of a series of bases and making an incredible and exciting move of 1,000%. And that's what new bull markets bring and why we must stay excited about the opportunities that are going to be there for us in the future as investors.
So for this series, we're going to do this over the course of 5 episodes. Today, we're going to talk about an overview of these patterns and why it's so important and profitable to use charts to spot these kind of bases. And you can do very well by learning just to spot 3 types of bases.
Now, we use bases to help us time, as Matt said, the optimum time to enter a stock. This is going to reduce your risk and help you maximize your gains. The charts that we're going to cover would be the cup with handle, the flat base, and the double bottom. So as Matt said, we'll cover 3 in this series and see why they're the most common bases that you'll find in investing.
And we'll get into the details of each pattern later in the series, but we just want to show you the concept of minimizing your risk by waiting for a stock to form and then break out of one of these patterns.
Now, Priceline formed a large and a very deep cup-shaped base in 2010. It was 37% in depth, and there was a high volume sell-off on the left side of the base. But as it came out of that structure, there was an enormous weekly spike in volume. The stock shot up 31%, and volume was 123% above average.
Now, of course, with hindsight, it's easy to say, look, you should have bought down here, but at the time, you didn't know if that stock was going to keep going lower or not. And that's why you minimize your risk by waiting for the stock to prove its strength and its resilience. You're going to wait for it to form the right side of the base and then break through this former ceiling of resistance on good volume. And if you do that, it's much more likely that the stock is going to go higher at that point, and there is still plenty of upside potential.
Now, bases are basically areas of price consolidations. This is when a stock is taking a breather before making a move higher. Or, obviously, a stock could fall apart and not necessarily form another base.
Absolutely.
That's why we have to wait to see if that base forms first.
That's right. And if you're new to charts or you're just short on time and want help spotting chart patterns, IBD helps you with that. In stock lists like the IBD 50, Sector Leaders, Big Cap 20, and others, you'll find a little analysis for each stock inside the mini charts, and it will point out bases and potential buy points. So it's a great tool to both improve your chart reading skill and build a watch list at the same time.
And this is helpful to you have a ready list and a universe list. This is what portfolio manager Mike Webster has said many times in the advanced workshops. Basically, your ready list is ready to go. This is the list. These are stocks that are ready to break out. Your universe list can be stocks that maybe are still forming bases, but they're not quite ready to break out. But the mini charts are unique to IBD, and they contain a plethora of valuable information.
Definitely a plethora of information.
Oh,
no
Matt.
question.
Oh, Matt.
Now, another key point about bases is that the chart pattern is just one piece of the puzzle. That's not the only thing you're looking at. You also want to look at the overall market conditions, make sure that those are favorable to buying, and also look at the company to make sure that it has the kind of strong earnings and other fundamentals that you're looking for. So stocks that make the biggest moves, they make them when all of those pieces are in place, not just the chart pattern.
And we will get decent market conditions again. The market can either scare you out or wear you out, so hang in there. We know it's been kind of a difficult, choppy year. I've plugged this before in the show, but I really encourage everyone to attend a Level 1 workshop. These are found all across the country, and we have now made this workshop free. And if you attend, you're going to get a more in-depth study of bases, and of course, you'll be there in person, so you can ask questions that you might have.
And next week, we'll get into part 2 of this series on spotting chart patterns, the kind that launch these big moves. And we're going to discuss 3 core concepts that you need to understand about bases. And once you understand those 3 core concepts, all of these patterns will make sense.
And in the next segment, we'll have a look at some charts and talk about good companies versus good stocks.
How would you like an edge that helps you pick winning stocks faster? An edge that is proven to outperform the S&P 500 by 76% since inception, and that you can take advantage of today without spending a dime. More on that in a minute. Each day, our top market team at Investors Business Daily scans our proprietary stock lists and screens to find superior stocks with the most potential for big gains. They analyze these stocks every step of the way to show you bases, buy points, sell signals, and the right time to take profits. It's about as close to hold your hand investing as you can get. Introducing Leaderboard by Investors Business Daily. For a limited time, you can try all of the premium features Leaderboard has to offer for a full 14 days at absolutely no cost to you. You'll receive unlimited access to all of the time-saving research, powerful investing tools, the leaders list, cut list, and expert analysis you need to develop a winning investing strategy. And it's all 100% free for your first 14 days.
Now, we just talked about the importance of charts and chart patterns, and that ties in very well to what we want to talk about next, and that is the critical difference between a good company and a good stock.
All right, Oracle may be a good company, but its earnings numbers have been negative the last couple of quarters. And its chart looks extremely weak also. So just because you recognize a name doesn't mean that it's a great stock.
That's right. And also, you might have a well-known company that does have great products and strong earnings and sales growth, but the chart action at the time isn't healthy. Now, maybe the market is in a downtrend too. So think of Apple in 2008. Great company, but not a great stock to buy at that time.
All right, here we are on a weekly chart. This is 2008. Now remember here, Apple had made a tremendous move that began in 2004 with the sale of the iPods, but the market began to run into some trouble. And like most stocks, Apple began a pretty severe decline and didn't come out of it until we started the new bull market in March 2009. So a great company making fantastic products, it doesn't mean that it's the right time to buy this stock, does it, Matt?
Absolutely not. So for the best chances of success, and again, as we talked about earlier, to minimize your risk and put the odds in your favor, you want a good market, good earnings and sales growth, and then also healthy chart action. And only one of those things was in place for Apple back in 2008 and for a lot of other stocks at the time too. But when all three of these came together in the new bull market in 2009, Apple launched a huge new run.
Now, Apple moved up 12 out of 13 weeks in a row, starting with the new bull market, March the 12th. And along with that, take a look at that RS line. It kept moving into new high ground. The negative pressure that had been keeping Apple down as we went through a brutal bear market was now lifted, and Apple took off.
So let's look at a couple of current examples. We have Ambarella, which is a leading developer of system-on-a-chip processors for use in GoPro and other action cameras. Very cool stuff. Also, their chips are used in security surveillance systems and drones. So it does have the innovative products, and it's in industries that have a lot of potential, and its fundamentals are also strong.
All right, here is a weekly chart of Ambarella. Now, Ambarella's numbers are still strong, and that happens a lot. The fundamentals can look good as a stock is topping and then even correcting. The earnings were higher by 162%, 184, and 138 in the three most recent quarters. Now,
and there's that saying about it looks good at the top.
At the top.
It often looks good at the top for stocks.
Yeah. Now, so a company can really have strong earnings numbers, and yet technically, this is why we need to look at the chart, and it's currently looking pretty weak.
Now, if you look back to its IPO in 2012 through basically the end of July of this year, it made a huge move, and it's still up about a 12-fold gain since the IPO close. But the recent chart action shows certainly weakness. So it qualifies as a great company, no question, but right now it's not a great stock to start a new position in. Certainly, it can come back, form a new base, and break out, but you want to wait for that to happen and see that resilience and strength before you jump back in.
But look at the accumulation distribution rating. So pros have sold some shares, and the semiconductor fabless group has a C+ rating. So it's not in one of the strongest industry groups right now either. It's just important to put the whole picture together when you're evaluating stocks. You want to look at the fundamentals and the technical action.
Now, another similar example from today is CyberArk, and it is a leader in the fast-growing cybersecurity industry, and it also has solid fundamentals. 3 straight quarters of triple-digit earnings growth and strong revenue numbers. So great company, but what about the stock?
Well, this stock had a terrific run. This was the great IPO. I know some of my friends made some nice money with this stock. It came public in September 2014. It broke out of a couple of bases, but then after the third base, it ran into trouble and it began to sell on the week of June 26th. And it fell below the 10-week moving average line. It also fell below the 40-week. Now, notice that the RS line, which compares the stock's price performance to that of the S&P, is slumping. It's falling down. It's falling over. And the accumulation distribution rating, which shows our professional buying or selling, is an E, and that is the lowest possible.
So that's not what you want to see when you want to get into a stock.
Not what you're looking
for.
But
watch the stock. It may bounce back. Ambarella may bounce back as well. And as they start to, you'll see an improvement in the RS line. You should see an improvement in the accumulation distribution rating as well. Again, you want to get those odds in your favor.
Absolutely. Now, there's a difference between a great company and a great stock, so always consult a chart before investing. So be sure to go check out your local meetup, and if you need to know where they are around the country, you can go to ibd.meetup.com, and there is a list of all of the groups that we have. I also want to take this opportunity to thank our meetup leaders who do a great job all over the world.
Absolutely. And we've actually interviewed many of the organizers of the meetup groups on our radio show. So we'll have links to that as well if you want to listen to those interviews. You'll find all of that, plus, like you said, where to find the meetup group that's near you at investors.com/investing show.
Okay. See you next week, everybody.